Have you ever wondered what happens when a company's stock value just evaporates overnight? Well, today we're going to dissect a really dramatic stock crash. We're going to look at the hard data to understand the anatomy of a financial collapse like this.
And this is the number that tells the whole story. In just one single day, this stock lost nearly 95% of its value. I mean, that's an almost total wipeout for anyone holding it. Just poof.
And to put that into perspective for you, a stock that was trading for about $1.25 yesterday is now worth less than 7 cents. Think about that. Every single dollar you had invested has shrunk to just about 5 pennies. So, that's the big question, right? How on earth does this kind of value destruction happen so incredibly fast? What does the financial crime scene actually look like? Well, that's exactly what we're here to figure out. All right, let's dive right into the evidence. We're going to go piece by piece through the technicals to really understand what went down here.
So first up, we have to talk about the selling panic, because to understand a collapse, you've got to follow the money and, the madness to see just how intense that selling pressure really was.
And wow, here's the proof of that panic. Just look at this. The day before the crash, a little over 1 million shares were traded. On the day of the crash, 167 million. That's not a spike, my friends. That is a tsunami of selling. There's actually a word for this in finance. It's called capitulation. It's that moment when everyone just gives up. They throw in the towel and they all rush for the exit at the exact same time, willing to sell for literally any price they can possibly get. And get this, this wasn't just a bunch of frantic trading. A confirmed $51 million actually flowed out of the stock. This tells us the big players, the serious money, they weren't buying the dip. They were leading the charge out the door.
Okay, so we've established there was a full-blown panic and a cash exodus. Now let's play doctor and check the chart's vital signs to see what the technical signals are telling us right now.
Well, the first and most important vital sign is that the long-term trend is completely shattered. Think of that $1.39 average as the main highway for the stock's price. This stock didn't just take an off-ramp, it drove clean off a cliff. But here is where things get really interesting. See, an event this violent, this extreme, it creates its own kind of bizarre signals. The sheer force of the crash pushes some of these technical gauges into territory they almost never, ever see.
The first tool we're going to pull out of the toolbox is the RSI, the Relative Strength Index. The easiest way to think of it is like a speedometer for a stock's price momentum. It tells us how fast and how hard the price has been moving.
So let's look at the reading. A normal RSI kind of hangs out between 30 and 70. Anything below 30 is considered oversold. This stock's RSI is at 15.75. That is deep in oversold territory, telling us the selling has been just completely excessive.
And honestly, this is the best way to understand an oversold condition. The selling pressure has stretched the price so far down, so fast, that it's just like a rubber band being pulled to its absolute limit. And at some point, it either has to snap back or break completely. And look, it's not just one lonely indicator flashing red. We've got a whole chorus of them singing the same song. The stock RSI has hit rock bottom at 0. The price is way outside its normal range. The data is practically screaming that this is an anomaly.
So here's the real conflict, the puzzle. On one hand, the chart is fundamentally broken. The long-term trend is just gone. But on the other hand, the selling has been so extreme, so panicked, that the math actually suggests a short-term rebound, or a bounce, is statistically possible.
So what do you do with these conflicting signals? A broken trend versus an extremely oversold condition. It's a real tug-of-war. So let's take a look at the risky path forward.
All right, so the primary conclusion from all this data is pretty clear. Despite the potential for a little bounce, the chart is broken. The damage is severe, which means any money put in from here on out, that's not investing anymore, it's high-stakes speculation.
And there's a name for this type of play. It's called bottom fishing. It's basically a gamble that you're smart enough, or maybe just lucky enough, to be buying at the absolute lowest point before a potential rebound. And let me tell you, it's a notoriously difficult and risky game to play.
So, for anyone watching this situation unfold, there are really only two numbers that matter right now. The floor, the critical support, is that recent low of just under 5 cents. If the price breaks below that, the selling is probably going to get even worse. And if a bounce does happen, the first major hurdle it needs to clear is way up around 41 cents.
And that leaves us with the final question, doesn't it? When you see a chart like this, a story of total collapse, what are you really looking at? Is it just a massive warning sign telling you to stay far, far away? Or is it, for the absolute bravest of traders, a very dangerous but very specific kind of opportunity? The data shows it's a little bit of both.